Popular Inc. beat consensus across the board this morning. Q2 revenue was incredibly strong, driving net income to $278 million. Basic and diluted EPS came in at $4.35. Management raised their full-year net interest income guidance, and they just authorized a massive $1 billion stock buyback, which actually sent the stock up roughly 3% in early trading.
Yeah, I mean, the market is absolutely loving those headline numbers right
Yeah,
now.
for sure. But here is the paradox we are unpacking on today's deep dive.
Hmm.
What if I told you a bank could lose $71 million on a single bad loan in one 3-month stretch, actively prepare their balance sheet for a geopolitical economic slowdown, and still confidently hand $1 billion back to its shareholders?
It sounds completely contradictory, but that is exactly what we are looking at with Popular Inc. today.
All right, the parent company of Banco Popular. Our mission here is to look under the hood of this highly profitable quarter. We want to understand the core engine of this bank, how one massive loan loss skewed their metrics, and what a major C-suite shakeup means for their future.
Yeah, and for you listening, evaluating a regional bank of this size, it isn't just about evaluating a single company. It's really a real-time case study in modern financial management.
Exactly. We're treating this as a masterclass in reading past those shiny headline numbers uh, to spot the structural dynamics hiding in the footnotes.
Because right now, Popular is balancing immense capital generation with some incredibly cautious macroeconomic forecasts. The top-line metrics suggest a bank operating at peak performance,
Right.
but the underlying mechanisms they are using to manage risk, well, they tell a much more nuanced story about where they believe the broader economy is heading.
Let's start by looking at that capital generation. Because the sheer volume of cash they're returning to shareholders is, it's the defining feature of this report.
Oh, absolutely.
Net income for the second quarter was $278 million. That is a $32 million increase just from the first quarter.
And a $68 million jump from this exact same quarter last year.
Right, which is huge.
A year-over-year leap of that magnitude is just substantial. And when you filter that down to the operational level, the metric that really stands out is their return on tangible common equity.
The ROTCE.
Yeah, ROTCE, which jumped to 17.02% this quarter, and that's up from 15.46% in Q1.
Let's break down why that specific metric matters so much. Tangible common equity strips out all the fluffy accounting assets, like goodwill or brand value.
It's intangible stuff.
Exactly. It looks strictly at the hard physical capital the bank holds. Generating a 17% return on that unleveraged hard capital means their core engine is running incredibly hot.
They are squeezing an enormous amount of profit out of every physical dollar they possess.
Yeah, but that operational efficiency creates a really unique problem, right? Excess cash.
Which is a great problem to have, but still a problem.
Right. They exhausted their previous $500 million share repurchase authorization by buying back $125 million of stock in just this second quarter alone.
Right, they just burned right through it.
And then management immediately announced a 20% increase in their quarterly dividend, bumping it up to 90 cents a share starting in the fourth quarter.
Yeah.
And then came the real anchor of the presentation, a brand new $1 billion common stock repurchase authorization.
$1 billion. It's staggering.
It is. And seeing $1 billion go out the door in buybacks, it makes me wonder about their internal growth models. Like, returning $1 billion to shareholders is mathematically sound, sure. But is it a red flag that they simply lack profitable new lending opportunities to invest that cash into?
That is the big question.
Because if you are a bank, your primary job is to lend money. If you are buying back $1 billion in stock instead, it kind of feels like an admission that the core business of lending is hitting a wall.
Well, it is an admission of the current macroeconomic reality. And it is actually explicitly spelled out in the updated 2026 guidance provided in their presentation.
Oh, really? What did they change?
Management revised their loan growth projection downward.
Okay.
So originally they were projecting 3 to 4% loan growth for the year. Now they are guiding toward the low end of that 3 to 4% range.
I see.
They are generating capital much faster than the current economic environment allows them to safely deploy it.
Which makes sense. Forcing loans in a high interest rate environment is a classic trap.
Oh, 100%.
If loan demand is softening, or if the risk-adjusted returns on commercial loans just don't make sense right exactly now, trying to source $1 billion out the door just to artificially grow the balance sheet, that is how banks ultimately blow themselves up.
Exactly. Which brings us to the mechanics of why a buyback is the preferred defensive move here, rather than, say, a massive dividend spike.
Right, because a dividend increase is a permanent structural commitment. You can't easily lower a dividend later without causing the stock price to just absolutely plummet.
Exactly. But a buyback is flexible. By repurchasing $1 billion of their own stock, they reduce the total number of outstanding shares on the open market.
Right.
So in future quarters, even if their net income stays perfectly flat, their earnings per share will actually go up simply because that profit is being divided among fewer shares.
It is a highly efficient way to reward shareholders while practicing, intense financial discipline.
Yeah, it really is.
But $1 billion in buybacks requires a massive engine constantly replenishing that cash.
Yeah.
When you look at how they are actually making their money right now, it all comes down to the spread.
The net interest income.
Exactly.
Yeah.
The NII was $693.4 million for the quarter. That is a $23.2 million increase just from Q1, which they said was driven largely by commercial loan growth and income from investment securities.
Yeah, and the critical metric alongside that is the net interest margin, or NM, which remained perfectly stable at 3.66%.
And for anyone who needs a quick refresher, the net interest margin is the fundamental spread between what the bank earns on its assets, like the interest on loans, and what it pays out on its liabilities, which is the interest it pays to depositors.
Right, and maintaining a stable margin of 3.66% in a banking sector where deposit costs have been fiercely competitive, that is a major operational victory for them.
The deposit side of that equation is actually where this balance sheet gets fascinating. Total deposits grew to $70.2 billion.
That is a lot of cash.
It is. But $22.7 billion of that total is purely Puerto Rico public deposits.
Wow.
Yeah, that is roughly 32% of their entire deposit base coming from the public sector.
That is a massive concentration.
Right, so think about it like this. If you run a catering business and you have one massive whale of a client who provides a third of your revenue, the volume is phenomenal. You love having that cash flow.
Of course you do.
But catering to that whale inevitably warps your internal costs. You have to hire special staff, buy specific equipment, bend over backwards to keep them happy. Holding nearly $23 billion in government deposits, that has to warp this bank's internal cost structure in a similar way, doesn't it?
Oh, it absolutely does. We see that cost warping effect materialize directly in the bank's interest expense. Total deposit costs for the bank actually ticked up to 1.57%.
Okay.
And management directly attributed this increase to the higher average balances of those exact Puerto Rico public deposits.
Because they aren't just sitting in a free checking account.
Right. Public deposits are not like retail checking accounts earning zero interest. They are highly rate sensitive. And furthermore, government deposits typically require collateralization.
Oh, right. The bank can't just hold the cash.
Exactly. The bank cannot simply hold the government's cash. They have to pledge safe, highly liquid assets as collateral to guarantee those deposits. So the bank pays a premium, both in yield and in operational complexity, just to keep that $22 billion in the building.
But here is where the math of the whale client works out in the bank's favor. Even with those higher deposit costs, management actually increased their full-year net interest income guidance.
They did.
They originally projected NII to grow 5 to 7% for the year. Now they are projecting an 8 to 9% jump. So they are paying more for the deposits, but they're projecting higher overall income.
Yeah, because the sheer volume of those Puerto Rico public deposits allows the bank to invest those funds into higher yielding assets, specifically exempt investment securities.
Like municipal bonds.
Exactly. Municipal bonds or Puerto Rico tax-exempt instruments. The yield on these securities easily outpaces the higher deposit costs.
Right.
But more importantly, because the income generated from these specific securities is often tax-exempt, the tax equivalent yield is incredibly lucrative. Earning 5% tax-free is the equivalent of earning 7 or 8% on a taxable asset.
Wow, yeah. So the spread they make on that volume more than offsets the premium they pay to the government.
Absolutely.
That spread is the engine funding the billion-dollar buyback. But, banking is ultimately the business of managing risk, and every loan portfolio has friction. Which brings us to the biggest, most glaring blemish on this quarter's report.
The credit quality front.
Yeah. The headline credit metrics present this really interesting contradiction. Total non-performing loans, which are the loans that are currently distressed and not paying, Those actually decreased by $45 million down to $413 million.
Right, so the backlog of bad loans shrank.
Exactly. However, the net charge-off ratio spiked by 44 basis points to 1.05%.
A jump of 44 basis points in a single quarter is a seismic move for a bank this size.
Right, a basis point being 0.01%.
Yes, so we are talking about nearly a 0.5% spike in the ratio of loans the bank has completely given up on and written off as a total loss.
And the presentation identifies the exact culprit behind this spike. A single commercial relationship went sour and resulted in a $71 million charge-off.
One single borrower.
One borrower. The original relationship was a $155 million facility. They took the $71 million loss, and the remaining $84 million was transferred to a category called loans held for sale.
Right.
Now, management insists this stems from borrower-specific issues and is not indicative of broader credit deterioration across their portfolio.
Well, moving that remaining $84 million to held for sale is a really fascinating accounting mechanism.
How so?
When a massive commercial loan goes bad, a bank has a choice. They can keep it on the balance sheet and try to slowly work it out with the borrower, which ties up resources and capital, or they can classify it as held for sale.
Okay.
By doing this, accounting rules force the bank to immediately mark the loan down to its fair market value today. They plan to auction this remaining debt off to distressed asset buyers, take whatever cash they can get, and completely clear the ghost off their books.
So it crystallizes the loss immediately, but it frees up the balance sheet moving forward.
Yeah.
But I have to push back here. Every bank calls a massive commercial failure an isolated, borrower-specific issue right up until the exact moment the rest of the commercial portfolio catches fire.
Of course they do.
I mean, when a borrower defaults on a $155 million facility, it usually implies structural cracks in the broader commercial real estate or industrial market. A hit this large is rarely born in a vacuum.
Skepticism is definitely required when dealing with commercial losses of this magnitude.
Right.
But to determine if management is being transparent here, we have to look at the forward-looking credit metrics, specifically the provision for credit losses.
Okay. Walk us through that.
So, under the current expected credit losses standard, known as CECL, banks are required to book provisions today for expected losses over the entire lifetime of their loan portfolio.
So they have to model future economic weather, basically.
Exactly. If management internally believed this $71 million loss was the tip of a systemic iceberg, the CECL models would force their provision for credit losses to skyrocket to prepare for the coming wave of defaults.
But the provision didn't skyrocket. The report shows the total provision for credit losses actually decreased by $10 million down to $65.8 million for the quarter.
Right. And that decrease is the strongest data point supporting management's claim that this was an isolated event. They didn't panic fund the reserve.
That makes sense.
Additionally, the report explicitly notes that consumer credit performance is improving, specifically highlighting lower auto losses.
Okay, and why does that matter?
Because typically, systemic cracks in the broader economy appear in consumer stress first. Regular people falling behind on car payments or credit cards. The fact that the consumer portfolio is strengthening while they take a single isolated commercial hit, it really supports the narrative that the core portfolio remains insulated.
So they survived the hit and cleared the books, but it still leaves a permanent mark on the year's report card. Because of the sheer size of this single event, management was forced to raise their full-year net charge-off guidance.
They were
originally projecting charge-offs of 55 to 70 basis points for the year. Now, they have bumped that guidance up to 65 to 80 basis points.
And the credit story doesn't even end with that guidance revision. There is a layer of macroeconomic caution baked into their allowance for credit losses, the ACL.
Right.
The calculation for how much cash they hold in reserve incorporates external economic models. And the presentation specifically notes that their reserve calculation utilizes a Moody's baseline forecast that predicts slower U.S. economic growth in 2026.
Driven explicitly by geopolitical conflicts.
Exactly. And just to be completely clear for you listening, we are absolutely not taking a stance on the politics of those global conflicts here. We don't do that on this show. We are strictly reporting exactly what the bank's internal models are using based on that Moody's data.
Right, we were just looking at the math.
Yeah.
But the point is, they are baking international geopolitics into their local loan reserves.
Yeah.
Even though the consumer auto loans are performing well and the commercial loss was isolated, the macro models feeding their risk algorithms are telling them to prepare for a slowdown driven by global politics.
Yeah, that Moody's overlay basically acts as a governor on their optimism. It forces the bank to maintain a fortress balance sheet today for a geopolitical storm that might hit tomorrow.
Navigating a landscape where you are juggling a $1 billion buyback, absorbing a massive commercial default, and modeling geopolitical recessions, that requires a very specific operational mindset.
Oh, definitely.
And the way a bank intends to handle that pressure is always reflected in who they put in charge. Which brings us to a major C-suite transition that they basically buried right at the end of this earnings report.
The changing of the guard.
Yeah. Let's run through the dominoes of this leadership change. CEO Javier D. Ferrer is retiring effective August 31st, 2026. The current Chief Financial Officer, Jorge J. Garcia, will succeed him as President and CEO on September 1st.
Right.
And filling the gap left by the CFO is the current Chief Risk Officer, Lidio V. Soriano, who is stepping up to become the new CFO.
It's a huge shift.
It is. It is kind of like a Formula One team promoting its chief engineer and its safety director to run the entire racing operation.
Yeah.
The numbers guy and the risk guy are taking the absolute top spots. There are no visionary sales or marketing executives taking the wheel here.
No, not at all. And the boardroom is sending a loud, unmistakable signal to the market with this, elevating the CFO to the chief executive role and then placing the chief risk officer in control of the finances.
Yeah.
It means the board is prioritizing capital efficiency, continuity, and pristine credit quality over aggressive expansion.
Which really connects every thread we've looked at today. When you authorize $1 billion to buy back your own stock, you are reducing your ultimate capital cushion. You have less room for error.
Exactly.
So putting a CEO who knows the balance sheet intimately alongside a CFO whose entire career is built on identifying downside risk, that ensures that the one isolated commercial charge-off we discussed earlier doesn't become a trend. They are putting the brakes on before they even see the curve.
It is a totally defensive posture. Having a former risk officer managing the finances ensures the bank is heavily insulated if that Moody's forecast of a geopolitical slowdown actually materializes.
Right.
They're configuring the leadership team to defend the fortress they have built.
So bringing this all together, this deep dive really paints a picture of a bank operating with a fascinating dual nature. On one hand, it is a story of phenomenal, undeniable profitability.
Yeah.
$278 million in net income, an ROTCE over 17%, and immense shareholder rewards headlined by that staggering $1 billion buyback and a 20% dividend hike.
Yeah. But on the other hand, it is a story of intense recalibration.
Exactly.
It is a management team absorbing a massive $71 million commercial hit, actively revising their loan growth downward, utilizing accounting mechanisms to clear bad debt, and orchestrating a leadership shift explicitly designed to batten down the hatches for a cooling economy.
And for you listening, this is the real value of looking past the press release. Reading the headlines tells you the bank made a ton of money, but reading the footnotes, understanding the collateral requirements of Puerto Rico public deposits, the mechanics of held-for-sale accounting, the Moody's geopolitical overlay feeding the CECL models, and the resumes of the incoming C-suite.
All of that tells you exactly how they are preparing for the future.
Right. They aren't victory lapping, they are quietly fortifying the walls. And that leaves us with a final provocative thought for you to ponder.
Okay, let's hear it.
We have seen the board allocate $1 billion to buy back their own stock, while simultaneously using a Moody's model predicting a geopolitical economic slowdown. If those global conflicts escalate and a recession hits harder than expected in late 2026 or 2027, will Popular's new risk-focused leadership ultimately regret handing that mountain of cash back to shareholders today instead of locking it in the vault for a rainy day?
This is a billion-dollar question.
Yeah.
Literally.
It really is. Make sure to follow the show for daily earnings coverage and deep dives into the financial mechanics moving the markets.